Celsius is a juggernaut in the beverage industry. The company is coming off a great earnings report, but is the stock a buy right now? We're diving deep into Celsius, from its growing market share to its solid balance sheet. Can Celsius soar even higher? Welcome to the Food Fund. If you own Celsius, or you're thinking about it, you need to watch this video. We've cut through the noise to focus on what matters. Let's start with the price action. Over the last year, you're looking at a 27% CAGR. Zoom out to 5 years, a crazy 48% CAGR. This company is a rocket ship. Market share, a key factor for food and beverage companies, is a strong catalyst for the company. The dashboard shows that Celsius is the third smallest non-alcoholic beverage company, but it is growing very nicely. They hold just 0.16% of the market share among public food, beverage, and restaurant stocks. Over the last 5 years, Celsius's market share has compounded at 49.9%. They've gone from 0.04% in 2021 to 0.16% today. I love to see market share grow like that. When we look at the fundamentals, the story gets even better. Let's dive into the numbers. First, gross margin, a nice 50%. Revenue has grown at a 61% CAGR over the past 5 years, now at $1.67 billion. Though growth stalled a bit in 2023 and 2024, revenue increase has been rapid over the past 12 months. Cash flow also looks amazing. Operating cash flow improved at a 56% CAGR. CapEx worsened at a 95% CAGR. The result? Free cash flow has grown at a 55% CAGR over the last 5 years. This is amazing. Though available shares have increased from 221 million to 234 million, the dilution has stopped since 2024. Let the shareholders rejoice. Next, return on invested capital. This tells us how efficiently they've invested in the business. From 3.9% in 2021 to 4.8% most recently, management has been driving returns, though not as fast as I would have liked. And what about their operational efficiency, measured by the cash conversion cycle? Well, it went from 143 days to 127 days, a minor but important improvement. I'd love to see this value fall even more. Finally, debt. Net debt to EBITDA has fallen from 5.5 in 2021 to 1.4 most recently. This means it would take Celsius a little less than 1.5 years of earnings to pay down their debt. This is a great position to be in. Now, let's compare Celsius's performance against the gold standard, the S&P 500. Investing $10,000 in Celsius would have grown to over $700,000, compared to more than $36,000 in the S&P 500. That's an annualized return of 55.8% for Celsius versus 14.4% for the S&P 500. With a 68.3% standard deviation versus the S&P 500 value of 15.4%, Celsius clearly has more volatility. Still, risk-adjusted returns, Sharpe and Sortino ratios, strongly favor Celsius. Celsius was founded in 2004 with a mission to create a healthier, calorie-burning alternative to traditional energy drinks. With a growing portfolio of brands, the company caters to a wide audience of health-conscious consumers. Employing over 1,000 people, Celsius is headquartered in Boca Raton, Florida, and has established itself as a significant player in the functional beverage market. The acquisition of Alani Nu has catalyzed the already fast-growing Celsius, and I do not see many roadblocks ahead for them. I give Celsius a 6 out of 10 using my proprietary scoring system. Before I share my final thoughts, if this analysis was helpful, please hit that like button to let YouTube know. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on Celsius. Let's write it out in the spreadsheet. It is a beverage company with a gross margin of 50%. The 5-year revenue per share CAGR is 50%, and the 5-year free cash flow per share CAGR is 40%. Beautiful. A return on invested capital of 5% is okay, but should improve. Next, the cash conversion cycle of 127 days is extremely high, but has been trending down. The net debt to EBITDA of 1.4 is very good. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 2.8. which means that Celsius is overvalued compared with expected earnings growth. Celsius' recent earnings report held some great gems. Revenue grew 84% to $739 million, beating expectations of $652 million. Even if we exclude revenue contributions by Alani Nu, Celsius grew revenue 9%, which is still good. Earnings per share grew 17% to 33 cents, beating expectations of 21 cents. Importantly, the Alani Nu acquisition turbocharged those gains. Alani Nu grew revenue to 129% to $301 million. And the best part is that shareholders got such growth at a great price. The $1.8 billion acquisition means that Alani Nu was purchased for a price to sales of around 1.5. To put this into perspective, Monster Beverage and Celsius trade at a price to sales of 7.8 and 8.3 respectively. Such a great deal. Celsius is a strong company, super popular with consumers and investors alike. Long-term investors have been handsomely rewarded, and I expect this to continue for some time. What do you think about Celsius? Are you an investor? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now, and remember to put your money where your mouth is.